Now, I talk a lot about finance because I think it's, in the end, the most important issue. And in order to help us do that, we're going to bring on Reggie Middleton. He's a private investor, and he wrote Lehman Brothers Dies While Getting Away with Murder, Regulatory Capture. It's a really interesting article. Reggie, welcome to the Young Turks.
Hello, how are you?
Great. First, tell me, because it's going to be critical to this conversation, roughly speaking, what is a Repo 105?
A Repo 105 is, in layman's terms, a method of creating a loan and making it look like a sale. Basically, in Lehman's case, it attempted to reduce the perception of risk of its balance sheet. So it would pledge assets on its balance sheet to lenders and get cash in return. But it characterized that transaction as a sale, as if it sold the assets versus pledged them as collateral in a loan.
So what it does is it makes it seem like you've got more money in your bank than you actually do. Is that roughly right?
Actually, it's the inverse. It makes it seem like you have less risk than you actually do.
Okay, so it doesn't build up your cash necessarily, but it decreases your risk when it's, in fact, of course, a trick. It's not really decreasing your risk.
Right. To explain how it works, let me give you a quick synopsis of the banking business. I'm a bank. I have $10 of my own money. I go and borrow $90. I now have $100, and I'm in the business of now doing deals and lending out money. But I only have $10 of my own money. A couple of days before they report to their shareholders, to the SEC, they make it look like they sold some of that $90 of assets off and have cash without the risky assets. So it looks like they now have $20 of cash and $80 of assets versus only $10 of equity and $90 of assets. And after the reporting period is over, they reverse the loan and bring everything back off on the balance sheet. And then the next reporting period, they do the same thing and reduce the amount of perceived risk. And they would do it every reporting period until, of course, the Ponzi scheme collapsed and everything imploded on it.
So, Reggie, this is an accounting trick, and is it fair to describe it as a telltale sign of a company that's in trouble and trying to figure out a way to juggle the money so it doesn't appear to be in as big a trouble as it actually is?
Right. A simple rule of thumb, any company that uses tricks is hiding something. And any company that hides something has something to hide. So this was definitely the case with Lehman Brothers.
All right, so Lehman Brothers does this, and it hides things, and then it collapses until it can't hide it anymore. Do we know who's doing Repo 105s right now among the big banks, if any?
Well, it would be difficult. If you focus on the semantics, such as the term Repo 105. It might be easy to say that no other banks are doing it, or some banks are doing it. The key is to forget the term Repo 105 and to see if banks are attempting to hide their financial problems. Now, I'm positive that there are many banks that are doing this. As a matter of fact, most of the banks that are doing it are not doing it with a complicit go-ahead of the federal government, and that's with the changing of the market rules. Practically every bank that gave out high LTV loans during the housing boom is underwater on their mortgages right now. So lending entities that are open and transparent by force because they collapsed are basically wards of the state and have received trillions of dollars of assistance, and that's Fannie and Freddie Mae. Every bank that gives loans just like Fannie and Freddie Mae's loans, and Fannie and Freddie Mae's loans would have driven them out of business if they weren't taken over by the states. But despite that, a lot of banks are saying that we're doing well, we're making profits, because they've been given the okay by the government to sweep the mortgage problems under the rug, so to say.
So, Reggie, you're in this business and you make money off of this, and my understanding is you made some money off of what you saw earlier. I'm not. So sometimes I even get lost in the details, although I've read as much as I possibly can on the issue. How did the bad mortgages wind up at Fannie and Freddie? I mean, did they go through the banks and into Fannie and Freddie, or did Fannie and Freddie, originate them in the first place? How does Fannie and Freddie relate to the banks?
Okay, there are two major types of mortgages. There are conforming mortgages, which are mortgages that Fannie and Freddie will buy from banks, and they're usually under a certain amount. It used to be $400,000 and change, and they complied with certain rules, such as fully documented the person had a job, they proved income, etc. And then there are non-conforming loans, which are loans that Fannie and Freddie will not buy. The conforming loans, all banks that wrote loans, so the vast majority of them sold them to Fannie and Freddie. So it's safe to say that whatever Fannie and Freddie has on their books is mirrored on the vast majority of the lenders in the United States, particularly those that don't keep their own loans on their books, which would be the big banks, the city banks, Wells Fargo, J.P. Morgan, etc. So Fannie and Freddie are in the business of buying these loans off of the banks, and they have a secondary business of insuring loans. So they issue insurance for those loans in case the payer stops paying, which is why Fannie and Freddie is in trouble. Many people either stop paying or can't afford to pay, maybe on foreclosures.
Reggie, wait. Let me get this right. Are all the loans at Fannie and Freddie now? Like if they go bust, it's the Fannie and Freddie's problem, or are they still somehow linked back to the banks, or do the banks just totally get rid of them and put them on Fannie and Freddie?
Well, that's Fannie and Freddie's problem, but Fannie and Freddie does have an out, and they're starting to exercise this out. There's a term called warranties and representations, and simply they say if you lied about the loan, you have to pay for it, the losses on it. And most of the banks who underwrote these loans basically look the other way. They call it ninja loans. These are no income, no job loans. And banks knew they couldn't be repaid, but since they were selling the loans off to Fannie, it wasn't their problem. It was the OPM principle.
So why is Fannie and Freddie buying these loans that it should largely know are crap?
It was part of the game, basically. I call it the greater fool theory. No matter how bad the loan is, as long as you're able to pass it down the line, you're not caught. The only problem is, you have to excuse my voice, please have a cold. Mm-hmm. The only one who gets caught losing money is the person who has the loan when the loan defaults. And ultimately, that has been Fannie and Freddie. But while the credit was very low and the housing boom was going on, everybody was playing a game that they knew was going to blow up eventually. And everybody knew it was going to blow up eventually. There were theories that alleged that it wouldn't blow up, but the theories were made out of kindergarten logic, such as housing prices will go up forever in perpetuity. And we all know nothing goes up forever. Whatever goes up must come down.
So, Reggie, let me get this right. And we're talking to Reggie Middleton. He's a private investor. Before I ask the next question, Reggie, were you an investor before the crash, and did you anticipate that at all? Did you make any money off of it?
Yeah, I was a real estate investor from 2000 to 2005. I sold off in 2004 and 2005. I then shorted all the companies that would do business with me in the real estate business. So in 2007, I shorted Countrywide, Washington Mutual, the insurance companies that insured the mortgages, such as MBIA and AMBAC. I shorted commercial real estate. I shorted all the regional banks, the major regional banks, and I left a public record of it on my blog. The reason was it was absolutely impossible for these mortgages to be repaid, the majority of them. And it was impossible for the rate of increase in housing prices to maintain. So the writing was on the wall. It was a guaranteed crash.
So you saw in 2005 what Alan Greenspan and the rest of the regulators claim could not have been seen.
Actually, that's not true. I saw it in 2004.
Okay, and you made, I take it, substantial money off that vision.
Well, it's all relative. I made enough to make it worthwhile.
All right.
From a return perspective, the returns were significant, mid-triple digits.
All right. That sounds good. And it's all in your blog, so people can't really argue with it. You have all the dates on it, et cetera. So now let's go back to the matter at hand. You're saying that the banks keep passing these loans off to whoever gets stuck with them in the end. That's it's a bit sad day for them. And of course, the people that are getting stuck with it are Fannie and Freddie because the government's going to pay for that. And then all the insurance for it all got put on AIG, and who's going to pay for that? The government's going to pay for that. So
let me correct you. The theory was that Fannie and Freddie would get caught with it, but what happened was just simply failed to buy the mortgage products because they saw that it was a Ponzi scheme, basically. When they stopped buying it, the banks themselves got caught with a vast amount of inventory. So now banks have it on their books as well as Fannie and Freddie, and that's why I started the explanation off. That Fannie and Freddie need trillions of dollars of assistance, and so do the banks. So from an economic perspective, more banks are technically insolvent. If you were to mark all their assets to market and mark all their liabilities to market, the liabilities will overcome the assets, and they're insolvent. They're worth less than zero.
So all of them are insolvent?
Not all of them, but a significant amount of the big ones and many of the medium-sized ones as well. And all the big name brands that you can think of, in my opinion, are insolvent if they were to mark the market today, right now.
And if they hadn't dumped a lot of it on Fannie and Freddie already, they would be massively insolvent.
Well, they would have went through Bear Stearns and Lehman Brothers if they didn't have the backstop of the government and be able to dump the stuff on Fannie. There's a lot of stuff that they have that Fannie wouldn't accept that still makes them insolvent, such as certain derivatives, CDOs, certain commercial products, etc. But the government has given them a pass by saying that you don't have to market the market. So basically they're saying it doesn't matter that you can't sell it. We'll take your opinion of what it's worth. And that's what got Lehman Brothers in trouble.
So, Reggie, if that's the case, does that support... Look, I'm trying to figure out how this thing doesn't blow, right? But, I mean, if what you're telling me is true and that they're still insolvent and they're still doing accounting gimmicks, despite the fact that they've unloaded so much on the American taxpayer already, well, isn't it going to blow up again and, you know, maybe fairly soon?
My opinion is it could go two ways. It's either going to collapse or the government may succeed in what they're trying to do, and that is to allow the banks to earn their way out of it. The problem is it's going to take a very, very long time. The Japanese government tried a very similar experiment about 19 years ago. And 19 years later, you know, only one of the top 20 global banks in 1980, 90% of them, about 90% of them were Japanese. Now, if you take a look at that same list now, only one bank exists on that list, and it exists in name only because it was a merger, and that's Nomura Bank.
But Reggie, in the last segment, we were talking about how the banks are recording record profits. They made more money on the books in 2009 than they've ever made before. But you're saying they're insolvent. How do those two things jive?
They made record accounting profits. Okay, if the government, if I'm in a hole, if I have $100 and I'm in a hole $150, and you tell me as the government, well, you don't have to worry about the $150 that you're in a hole with. You could just count the $100, and then I make $20 next quarter. I say, listen, I made record profits, and I can say that as long as I don't have to look at the liabilities that I have, and that's basically what happened. Now, if you take an accurate look of all the liabilities and all the assets and all the economic earnings, not just the accounting earnings, and market to market, they're insolvent.
All right, one last thing, Reggie, and that's derivatives. I happen to think that they're actually the number one problem because they allow gambling, they allow greater leverage, and as a gambler myself, I know that if you gamble enough, and certainly with more leverage than you should, you're headed towards a disaster. It doesn't appear that they've reformed any of the leverage requirements or really touched the regulation of derivatives. Am I misplacing my concern there? Or am I right? Is that a giant concern? And what's happening lately with that, with the banks?
You know what it is? I disagree with the premise.
Oh, okay.
But your concern is correct, but the premise is wrong. There's nothing wrong with derivatives, so to say. The dollar bill was originally a derivative. derived its value from a portion of gold. So derivatives in itself are not bad. The problem is custom derivatives that are traded privately versus through an exchange can be very risky potentially, which is not a problem as long as the banks are risking their own money and they're not in a situation where they can force a bailout from the government. But that's not the case right now. A lot of the banks that are doing exotic private derivatives in secret, so to say, or between two parties without an exchange and without direct oversight from a regulator, are also the same banks that are holding grandma's CD that's FDIC insured. That's why I'm a strong advocate of the Volcker rule. Paul Volcker basically said, if you're going to do any risky gambling using derivatives, proprietary trading, etc., you have to separate that entity totally from any FDIC or government-insured banking business.
Reggie, if they're doing custom derivatives, how does that affect like their leverage? How do we know how much leverage they have if they're doing custom derivatives in private?
You have absolutely no idea. I could do a deal with you where I say, I'll give you $1. You'll give me 22 times what the euro value of the euro is in return, plus X. If the euro goes up or if the euro goes down. And I could take this deal, I could create it, I could take it off of my balance sheet and put it in the company that exists off balance sheet. And then I can actually take borrowed money and use it to pay for that particular deal. So if that deal has 22 times leverage, it really has, if I borrow money with using 10% equity, that 22 times leverage deal now has 22 times leverage times another 9 to 1 leverage. So 9 times 22.
All right.
So the banks can have an extreme amount of leverage, but you would never know because the deals are privately negotiated and they're over the counter versus through an exchange.
Reggie, that seems to buttress my point. If they have the possibility of, about 200 to 1 leverage in these secret deals that we don't know about, as a gambler, I think that is a guaranteed blow-up. I mean, they're going to lose that money at some point, and we're going to run right into the iceberg.
Well, and honestly, I would have no problem with it as long as this was only their money that they lost. But again, when they are large enough to be systemically relevant, such as Goldman Sachs, or if they are a bank that is FDIC insured, which basically means they can endanger savings accounts and checking accounts, and the government has to run in to save them, then that's a problem. Now, Goldman is technically a bank or a financial holding company, and so is Morgan. As a matter of fact, all the large investment banks are now protected by federal guarantees. So, in my opinion, they should not be allowed to do anything off balance sheet.
Reggie, as a final thing, I got to press on this because I don't understand why I'm the only one freaking out about these derivatives. And when I say derivatives, I use that as a short term. I know that there are perfectly legitimate derivatives, right? So custom derivatives, sometimes what they call naked credit default swaps, where they're just purely gambling. If they can leverage up to 200 to 1, as you just explained, why isn't that the biggest deal? Why isn't everybody freaking out over that? Why isn't that the obvious iceberg that we're going to run into?
Well, there's a term, regulatory capture, and I use that term in the Lehman Brothers article that you cited earlier. The regulators that oversee a lot of these companies are actually captured by the companies they oversee. In a perfect world, and in a world where the regulators were originally envisioned, the regulators were supposed to look out for the common man, the voting person, the individual taxpayer. But over time, the entities that the regulators regulated became so influential that they took partial control or gained undue influence over the regulators. So the regulators' interests are to serve a myriad variety of constituencies, and that myriad variety of constituencies doesn't necessarily have the individual taxpayer, which is you and I, at the top of the totem pole.
So, Reggie, shouldn't you be shorting the whole damn thing? I mean, still to this day? Because, yes, I agree with you. The regulators have been captured. They probably, a lot of these banks are secretly still leveraged up to the hilt with these custom derivatives. So to me, it seems like another crash is almost absolutely inevitable.
In my opinion, I think there's a big one coming. Now, there's economic reality and there's stock prices. Sometimes they diverge. Right before the Great Depression, right before the black market crash in the early part of the 19th century, economic reality and stock market prices diverged until they converged once again, and that was the market crash. We had another convergence in 2008, which is the most recent market crash. My opinion is 2009 represented the forces of regulatory capture at work, and that the repealing of mark-to-market, which allowed bank prices to basically skyrocket. And many banks are trading at roughly what they were before the market crash, despite the fact, as you aptly noted, most of the problems are still in existence. As a matter of fact, not only are most of the problems still in existence, most of the problems are actually worse than they were in 2008. Because you had several banks collapse, you have less counterparties now than you did in 2008. You don't have Lehman Brothers, you don't have Bear Stearns. So all of the risk that is shared amongst the big banks are shared by a much smaller group of individuals.
All right, so the problem is actually worse than I suspected. We've rebuilt the bubble. The banks are larger, and they're still doing the same exact things that they did before that created the problem. And on top of that, what you originally explained is that they're insolvent in reality. So when you add all those things, Reggie, if you can wait a couple of years, short the living hell out of everything you can see.
Well, I don't think it'll be a couple of years. It won't be that long. If you haven't noticed, Europe is having significant problems. Sweeping their problems under the rug as well. It's coming up far. We have Greece, Portugal, Spain, etc. A lot of the banks, the global banks, are interconnected. If one or two of those nations default on their debt, the banks that hold those debts are going to call upon their derivative holders, which they have as a hedge, to back up their debt. And I believe it's a large Ponzi scheme. Nobody truly has the money to pay. So if we have a default of one or two of those nations, I think that the strength of some of our banks will be put to the test again. Not directly, but indirectly, as the daisy chain, the dominoes fall, and all the derivative hedges are going to be called.
All right, so in the end, it's not only worse than I suspected, it's coming quicker than I suspected. All right, cheery news today. Reggie Middleton's a private investor, and he accurately predicted exactly what was going to happen in 2008, all the way starting in 2004. And if he's right again, we're all in a world of trouble. Reggie, thank you so much for joining us on the Young Turks. It was a very informative conversation.
You're welcome very much, my friend. Have a good evening.
You too.